Hey, so guys, this is our first YouTube live streaming of our Let's Talk Jason Investing.
Yes.
Kenneth, you want to do the introduction first?
Yes. Sure. Okay. Welcome to the Let's Talk with Jason episode 3. In this podcast, we will discuss how ordinary people can invest in the S&P with dollar cost averaging, leveraging options to maximize returns and lower risk. And we would also teach you some finance and option skills. This podcast is sponsored by JasonInvesting.com. It's a newsletter that shows you how Jason invests in the S&P and SPY. Today, we are actually hosting a live stream where Jason is going to go through the basic finance and trading options. Joining us today, my co-host Andre and also the CFA Jason. Okay, Jason, I'm going to pass it to you.
Hey, thanks, Kenneth. And also joining us is Andre. Andre, do you want to say something first before
Hi everyone. Hope today will be a really good lesson for everyone to learn about the many finance questions that I have, and I hope that everyone will have that same kind of queries.
Yes, and
Thanks.
I'm hoping that you will feel just as excited as Kenneth. Today, we're just going to cover some of the basics, trading and introduction to the stock market. I mean, things that for most people who are unfamiliar with trading and finance, this will be a very simple and introduction so that you can get acquainted with what we do in Jason Investing. I think a lot of people were giving the feedback that the options podcast is a little bit too hard for them to understand. So that gave us the inspiration to start with something simpler. So okay, the function of a stock market is actually to allocate capital for companies. So you can just imagine, right? Say a company has people have some idea about a certain business, right? And they need to get funding for the business. And one way to get funding is via the stock market. So basically, these are like public companies, right? So basically, these companies are already pretty successful because in order for you to be listed in the stock market, you need to have to meet certain criteria. But the main purpose is for business to get the capital for them to expand on their business. So you think about this. If so the way for you to expand your business is to first get the capital to maybe to buy equipment or to acquire certain technology or whatever. Basically, all this needs money, right? So there are a few ways that you can do it. Basically, if you are just a new company with no record or something, you probably invest your own money. You're putting your own money into the company, or you could ask your friends or relatives. And then when the company gets a little bit bigger, you can take a bank loan. And then as it gets even bigger, you can even issue bonds. And eventually, you might want to get outside capital and list yourself in the stock market where people can actually subscribe to your shares. So the way it normally happens is companies will go through an IPO, which is initial public offering. So they will engage an investment bank to do the underwriting for them, right? So basically what will happen is that the bank would guarantee to the company that your shares, okay, so first of all, they will work out how much money they need for the capital, and then they will determine a price that they feel that will be accepted in the market. So they will do a lot of the analysis and all that to come up with a price. Normally they will put the price slightly lower to entice people to buy, because it will be kind of embarrassing if you list a IPO price that is rather high and on the first day it drops, right? So they will normally list at a price that is fairly low value. So people who subscribe to the IPO are able to get a capital appreciation on the very first day. And the bank, they will underwrite. So underwrite means the bank will actually buy all the shares first. And any subsequent, and then they will guarantee the amount of money that the company will get. So okay, so the definition is okay, and so once so this is just the initial public offering. So once they get the capital, now the shares are traded in the secondary market. That is the concept where you guys think of stock market, right? It's about shares trading and the share price, stock ticker keep moving up and down. It's very risky. All these are in the secondary market, and theoretically, whatever price that is trading in the stock market, the money actually doesn't go to the company. So, for example, the company issue 100 shares, right, at a price of say $1. So the company took in $100 capital, and for some reason, immediately on the first day, it doubled to $2, right? So the company is now worth $200. But the capital that the company has is only $100 from the beginning. So any capital share price appreciation doesn't directly goes to the company. You guys have any? Andre, you have a question?
Yeah. Do all countries have their own stock market, and which one is the best one?
I mean, I would think that every functioning economy would need to have a stock market, but a lot of times, but the stock market is not the only way that you can get the capital for your business, because a lot of times some companies might not even want to go public. Basically, they're private companies, right? They don't want to go public. The reason why they don't want to go public is because the act of going public is very intensive in terms of all the legal documents. You need to make your financial statements public. You need to run, you get an auditing firm to audit your financial statements. There's a lot of other requirements that you need to fulfill, right? And all these are very time consuming and also involve a lot of money as well, right? And even the act of going public involve a lot of money, because you need to pay the investment bank to do all this for you, right? And the investment bank actually get a huge cut from how much. I'm not exactly sure what is the standard, but you can imagine that every IPO, the investment bank gets a cut of the amount that you raise. So all the money you raise, not everything goes to the company. So it goes to all various channels and stuff. And also another thing that some companies don't like to go public is because once you go public, your company will be scrutinized by everybody, right? All the business analysts, all they will look at your financial statements, and all the shareholders will demand that you increase the stock price of the company, right? It's like you maximize the gain. And some companies, private companies, they don't think in short terms, right? They want to go for longer term. So things that might not show improvement in the near future, maybe the market does not like it, and the company might be forced to, accept what the public wants. So they lose some kind of control as well.
Okay, so let's say my business is really successful, but unfortunately, I'm in a undeveloped country or a very small economy country, such that it's either I so which means does my business have to be listed in a larger economy country for it to be successful? Or let's say my country has got a stock market, but the stock market is really small due to my country's stability. Does it mean the success of the stock market depends on the how the confidence level of the public as well?
Um, in a way, it does. A good example would be Creative Technologies. I don't know whether Kenneth know about this company. So Creative Technology is a Singapore company. You know the Sound Blaster sound card in the past, right? Back in the 90s, the Sound Blaster is the most popular sound card, and apparently it's actually from a Singapore company. So Creative Technologies, I think they were listed in the Singapore Stock Exchange, but they were also listed in Nasdaq in the US. The reason why they want to list in the US because most of the business revenue is from the US. That's one reason, and the reason is also for them to make themselves available to more people to buy their shares, right? So to basically to be able to raise more money. So even in China, there are a lot of companies that list in the US as well, and like they list in Shanghai, Hong Kong, and also the US, basically to reach out to more people. Yep, Kenneth, you want to say
Yes,
something?
I want to go back to your explanation of the market, right? You were talking about when the secondary market, when they buy shares, the price goes up, right? And then they said
Right.
to $1 to $2. And then you mentioned that the money doesn't go to the company, right? Directly. Where does the money go?
Okay. If you buy the shares, you are the shareholder, right? You are already a shareholder.
Yes.
You're already part of the company. So if it goes up to $2, basically in the market, somebody will be able to buy your shares for $2. So if you sell your share to the person, you will get the $2. So it's kind of like Andre like to always talk about paper profit, right? The paper profit or paper loss. So in a sense, it's like a paper profit. Basically, a company already has like a $2. So what the shareholder, the founder probably will have a lot of shares, right?
Yes.
So even though the money doesn't go in, they don't have it directly, but the valuation of the shareholders' equity in the account statement, in the balance sheet, will already raise in price. But they don't have that cash, but they can always sell the shares. Right? They can sell the shares to get the money. But in most cases, what this company does is once the share value goes up for the company, they can issue more shares, right? So when they issue more shares, and now they can issue at a higher price because now the valuation of the company is higher. So for them to raise a second round of funding, they can get a lot more money. Basically, it will be like double of what they got initially. But of course, any further issuance of shares would dilute the potential shares at the beginning. But it will be fine, right? Because, for example, the founder will have a lot of shares. Like maybe the founder initially has like 80% of the company, but now the company worth so much, he can basically let go of like 10% of the company for the public, and then he just rip in the profit. And basically people can issue more share. The company issue more share, and more people can buy. As how they raise more money. Yep, Andre.
Is there a reason why the US Nasdaq is always the most popular one?
The Nasdaq it's not actually the most popular one. There are a few stock exchange in the US. Like the biggest one I would think is the New York Stock Exchange, the NYSE, right? Nasdaq it's another exchange. So there are a few exchanges in the US. But for example, in the S&P 500 index, they consist of stocks that are listed in, they might not be all in the same exchange. It could be in NYSE, another one could be in NASDAQ, and I think they have other American exchange or something. Yeah. Yep.
Yeah, so I
Yeah.
think it's better to move on because we probably have a lot of slides.
Yeah.
Finish, yeah.
Okay. So if you guys know about accounting, you will know that the balance sheet, right, where you have the assets on the left hand side, the liability on the right hand side, and the ownership equity. So assets equals to liability plus ownership equity. So initially, whatever shares that you issue, that will go into the ownership equity, right? So if it's a public company, you issue shares. If it's a private company, probably the funding comes from yourself. So that will be the equity. And so whatever equity, so because the left hand side and the right hand side has to balance, so the assets will always equals to the liabilities and ownership equity. So okay, we start off with something really simple. When you first incorporate a company, you have like just equity, right? You put in say like okay, so for example, the three of us we form a company, JasonInvesting. Each of us put in $100, right? So we have like $300 in the ownership equity. So and then the assets will be the cash that is being put into the company, right? And then from the cash, you can use it to buy equipment or to hire people or yeah, basically like let's say you buy equipment and inventory, so that will be the assets, right? And the liabilities could be, for example, you want to borrow money from the bank, or you take issue bonds. All this will go into the liabilities. So for a normal company, even be it a private or a public company, this is the same across the board. So you have this assets equals to liabilities plus ownership equity. But this was
So
just the
yeah,
yeah,
so that means at the beginning, if we form a company, right, using an example, we each put in $100. On day one, right, the assets is $300, and then it will be equal to the ownership equity of $300, right?
correct.
The liability will be nothing because we haven't issued bonds or haven't get any debt.
Correct.
Okay, got
Yeah.
it.
But you could have, for example, expenses. So, if you say, oh, actually, once you start buying equipment or inventory, all these, then your liability will start going up.
Okay.
Yeah, it's just that you just So all these, uh, yeah, and on top of the like you're borrowing bonds or whatever, all this will also go. But in a nutshell, they will always have to balance each other. But at the end of the day, the the company, the corporation is it's just empty, right? Whatever assets that you have, you are it's owed to someone else. At the beginning, it's just owed to the whole shareholders. But as you get more and more fundings and stuff, either your shareholder grows or your liability grows. And either of them grows, the asset will grow as well.
It's bonds. Why does a company have to issue bonds?
Okay, that's a good question. So why okay, you can think of shareholders equity as a cheap form of funding because you don't have to pay interest, correct?
Mhm.
If you get more shareholders to come in,
Yeah.
basically these are like uh, low cost funding money because you don't have to pay any interest. And if your company go bust, all these shareholders will lose everything,
Yes.
right? Because they are the last in line to get any form of uh, compensation from the company. But while bonds has a higher status in the sense that if a company were to liquidate, whatever asset that is sold will always pay off the bond holders first. And any money that remains, in most cases, almost no money left. So basically, shareholders will lose everything. So the shareholders are the ones that carry all the risk, but they also carry most of the gain if there are any gains. You just imagine if the stock market goes up, if the share price goes up for the company, who are the ones that actually gain from this? It's only the shareholders that gain from the stock market appreciation. The bondholders are not going to get any appreciation because their bonds are fixed at a fixed interest, or it could be a floating rate bond, but it's based on market interest, right? It has nothing to do with the share price. So in a way, it's safer for bondholders because they get interest, but for shareholders, they get all the appreciation and also the loss in the stock market.
Okay.
So yeah, so one reason why a company want to borrow money from the bond market is because, first of all, they don't need to dilute their share of the company, right? Because every time you issue more shares, you're actually diluting whoever is currently having shares in the company. So you might not want to um, give out your company so easily like this, especially at the beginning where your market has a very low value. Just imagine you go issue shares at a measly low price, right? So you're giving out the ownership of a company at such a low price. But of course, if your company is as valuable as Apple or Google, Alphabet, then I mean you'll be more than happy to issue shares, right? But if you're just issuing as this like low amount of money, you might be better off just borrowing from the bond market, but basically issuing debt. Because you only need to repay this debt, you don't have to sacrifice any ownership.
Okay, I see. So let's say we have our company, right? Like Jason Investing, right? How do we, like, who's going to buy the bond if we issue the bond?
Okay, initially nobody is going to buy bonds of a company like sad to say JasonInvesting, because it's so small, right? I mean, how do you issue bonds? You need to go look for a bank to issue the bonds for you. And no bank is going to help you issue bonds when they feel that there is like no demand for the bond, right? And you have to pay like a service charge to the bank to issue all these bonds. So for small companies, they will not issue bonds. Bonds are normally for either very big private companies or public companies, and the bond notional are normally very big. So what they usually do for a small company at the beginning, is that they just go to the bank to take a bank loan.
Okay.
Yeah, and the bank loan will be kind of like will be a higher interest rate. So if like for example a bank loan versus a bond, if the amount is high enough, most cases you will get a lower interest rate. Overall your cost will be lower for if you issue bonds, because of all the other hidden charges and everything. If the notional is not big enough, you are still better off with a bank loan. And even for a bank loan, normally the bank would not lend you so much money, right? Because the bank is very afraid of counterparty risk, right? Because they know that most probably your company will not make it, and if your company goes bankrupt, they're not going to get any money back, right? So to them, that is very risky. So they will not, even lend you a lot of money. In fact, there are actually large companies that take money loans from banks. And even in those cases, the bank will not loan so much money to the company. What they usually do is they will do what we call a syndicated lending. So they will work together with other banks to cut the loan into multiple pieces. So each bank would have a portion of the loan. So just in case you go bust, basically the not only one bank would suffer. There are a few banks will all suffer at the same time, right? So reduce your counterparty risk. I don't know you guys whether you know the Archegos, the Bill Huang guy. So he actually took he exposed to a lot of banks, right? And in the end, a lot of these banks lost a lot of money. But it's not like just one bank, right? They will spread out the risk.
Okay.
Yes. Yeah, Andre.
Bonds, is that always between the lender and the borrowers? How about the investors?
Okay, so bonds can be sold to anybody. So a bank loan is only for banks, right? So the bank will loan you the money.
To
For
the business.
yeah, but for bonds they can anybody can buy. A bank can buy, other corporation can buy. You can buy it too. But most of the time, the notional amount for bonds are very big. So for most people, they will not be able to afford the
Okay, so
bonds.
yep. So when you say long term, let's say as a private investor and a bond gets announced and issued out, what's long term? Is it something that is not to me is not liquid?
Uh, okay, so whenever you go into debt, right, you have this concept of maturity, like a bond maturity.
Hmm.
So a bond you can issue like a 6 month bond, you can issue a 1 year bond, 10-year bond,
Uh,
30-year bond. You can even issue a perpetual bond, basically a bond that never expired. So in the past, the UK government, right, actually issue a lot of perpetual war bonds for World War II, right? So they pay a fixed interest rate perpetually forever.
oh,
Because of inflation, right? Now the money that they pay the interest is as good as nothing.
oh yeah.
But basically there's a maturity to the bond. And so what normally companies do is that they stagger their maturity. They issue some short
Oh,
term, some medium term, some long term. So, for example, a good example is that recently the Fed they raised interest rate, right, from near zero to like 5% now, right, 500 basis point, 5 to 5.25, and it said that a lot of large corporations are not really affected by this interest rate hike because they already lock in a lower interest rate in the past. So what happened is that because of the previous financial crisis or whatever, so all these treasury departments they stagger their maturity, right? So they do not just issue short-term bonds, they also issue longer-term bonds. So now that they already issue all the longer-term bonds in the past, like for example, if you issue a 30-year bond back when interest rate was still low, they already lock in the rate, right? So now even if the Fed were to raise the interest rate, it doesn't really affect them, right? Because their loan is not going to expire anytime soon. If they don't need any extra money, they are not in any issue. But of course, if they issue a lot of short-term bonds, okay, so normally what a company does is they borrow money, right? When it's time to return the money, like they don't just return the money. What they do is they issue a new bond to take the money to give out repay the bond that matured, right? So they just roll their borrowings to the future. Unless they have a lot of cash, they can repay the bondholders. So it's the same for government as well, right? Government debt is ever growing. So what they always do is that they just issue new bonds to pay off the older bonds, so that to if not they have no money to pay, right? They are always issuing more debt. And another way to think about this is also, for example, if you have a lot of cash in a company, right? You have a lot of cash in a company, especially like companies like Apple, they have a lot of cash, right? And the reason why they have a lot of cash is because they want to avoid tax. And this cash are because from revenue from selling their iPhones in other countries. The moment they transfer this cash back into the US, they'll be slapped with a huge tax bill, right? So what they do is that they just leave the cash at the overseas or whatever. But the thing is, so what do you do with the cash? So what this company does is that they will just buy government bonds, right? So the bonds that we talk about is corporate bonds, like basically companies that issue bonds. Government can also issue bonds. But government bonds, of course, the interest rate is the lowest. Basically, they are the base rate. Any other company bonds is always a margin on top of the government bonds. And so these are treasury bonds. It could be treasury bills, notes, or bonds. But basically, treasury bills are below a year. Note is 1 to 10 year. Bonds are 10 or more years of maturity. And because, okay, just imagine if you have a lot of cash in a company, right? So what normally, okay, let's say you have like $1 million cash in the company. Say JasonInvesting makes a lot of money. We have like $1 million lying in our supposedly in the balance sheet. So what do you do with the $1 million in cash? Are you going to keep the $1 million cash in the bank? This thing a lot of people might not know, right? Is that nobody will keep $1 million in the bank. Why? Because of counterparty risk. The bank, because of 2008 financial crisis, even Lehman Brothers can go bankrupt, right? Can go bust. That's too big to fail. Even big banks would fail. So you have one counterparty risk. So and banks also has a limit. They don't want you to put so much cash lying in the account as well. So what they do is they will just buy treasury bonds or bills, basically government bonds. And that's so normally you will hear that, because the treasury bills are basically as liquid as cash. They're as good as cash. So if you have like millions of dollars, billions of dollars, it's not cash lying there, because cash also don't get you any interest, right? Very low interest to no interest. It's the bonds that are paying you an interest. If it's the treasury bills, the government will be paying you the interest. And for most corporation, if they have a lot of cash, they don't go and buy corporation bonds, because corporation bonds is very risky, because the company might go bust as well, right? So normally you just park it with the government bonds. Kenneth?
Is the treasury bonds pay out better than the GIC?
Okay, so the government bonds are always the lowest interest rate. So when the Fed raise or cut interest rate, they are cutting the short-term interest rate, basically overnight interest rate, right? And that is the so any interest rate that you want to borrow from the market as a company or even as an individual, mortgage rate or whatever, all these rates are always higher than the base rate. So the base rate is a government rate. So if the government raise the like the Fed, right, the central banks raise the interest rate, all the interest rate will all go up.
Okay.
And they will have a margin on top of the government rate. And the reason why a corporation has or pretty much anybody else other than government will have to pay a higher interest rate. Okay, if you think about this, you want to lend money to a company A and the government, right? The US government, or say the JasonInvesting. The US government is paying you 5% interest rate, right? And then JasonInvesting say, I'll pay you 4.5%. You will be like, okay, you can go home, right? You fund okay lah. Then what? 4.5%. I can get a risk-free interest rate at 5%. You want me to lend to you at 4.5? Go continue dreaming then. And in order for me to able to attract people to buy my bonds, to lend me money, I will have to at least go above 5%, right? And if my company is very, very risky, then I will have to pay like 2%, 3% on top of the 5%.
Okay. It's 35 minutes already, so
yeah.
We can move on.
Yeah. Okay. So we have this long-term debt securities issued by corporation, municipalities, states, and sovereign governments. So basically, what I was saying just now, right? You also have bank loans. So normally, bank loans are for short-term, mostly, but not all cases. But bonds it could be any term. And yeah, so this slide, we have actually already gone through this. Like, why would you prefer debt over equity? So there are pros and cons to each of them. Let me see whether I have any missed out anything. So like you see, you will reduce the ownership percentage, right? There is the downside of equity. Whereas, okay, and also no repayment obligation, right? So if you're raising money through equity, you don't actually have to repay anybody, right? Because there's you already the shareholder, you are part of the business. If the company were to fall, you just lose everything, like, in terms of the share price. And yeah, and also because there are certain conditions you need to fulfill when you take a bank loan or even for bonds. Sometimes you need to make sure that you have enough collateral, and also certain obligation that your debt couldn't go up to a certain level, above a certain ratio. If they consider that as risky, then a bank will not issue loans to you.
Jason, are you able to increase the screen size a bit, please?
Okay,
Yep, thanks.
let me just
Okay.
yeah, just see this. Okay, just stop me if you guys have any question. Okay, after we talk so much, we didn't even talk much about stocks, right? Okay, so stock or shares represent ownership in the company. Okay, so you guys understand that, right? So okay, so what is the okay for common shares? You have voting rights. So what? Okay, so from my understanding, shareholders couldn't they cannot possibly monitor the company all the time, right? And neither do they have the expertise. So normally for a public company, the board of directors would represent the shareholders, right? And the board of directors are there to supervise that the company is actually doing the not doing any fraudulent stuff. And basically the board of directors are representing the shareholders. And in certain cases, if they want to vote for certain things, maybe via the board of directors, then the shareholders can vote. Or the shareholders can ask the board to say, oh, they want to vote on certain things. For example, they might want to get rid of the CEO because the CEO might not be performing well or whatever. Then basically they can vote. And if you have like more shares, you will have a more voting power. Basically, you can change the direction of the company. But for most people, when you're buying shares in and out of the stock exchange, it's very insignificant. Any one person is insignificant, but as a group, it's significant. Yep, Andre.
But most of us as stock buyers or investor, we don't really. I mean, if the decision of company is based on the board of shareholders, we don't really question or get to know who makes up all these board of directors or shareholders.
Everything will be in the they have an annual meeting, and all this information will be public. You will know all this information. But most people, they cannot be bothered.
Yeah,
of
because
course,
most of us will be only recognizing the fact, oh, this Apple is really big and powerful, and yeah, let's invest
yeah.
into it.
But you don't have to worry about this, because somebody will oversee this for you. Do you know who they are? It's those
The market.
the business analyst, also the market as well. In general, the more popular the company is, there'll be more business analysts analyzing the company, right? The shareholders. You have all this media always reporting on the news of the company, and all this they will be asking questions, and they will be so for like normal people, especially if the market is very developed and stable. You will have less of such worries. But of course, if you are in a very developing country where things are a little bit more shady, then that might not be the case.
Yep.
Yeah. And there's another thing is, if your company has a lot of cash, and their cash is from revenue, right? You can you can you can return the cash to the shareholders via dividends. So a way to look at this is a stock market price. So what actually what does the stock market price actually represent? So remember, we have $1 a share, then it goes up another dollar, right? It becomes $2. You appreciate. Like what does that mean exactly?
The value of the business, if something goes wrong, that is how much each share will be cost.
Uh, I think you get the gist of it. But so it's like as the valuation of the company goes up, that means the market is saying that the company has the potential to make a lot of revenue. It might not be now, but it will be in the future because the stock market is a forward-looking mechanism. It looks, it predicts, it tries to look forward in the future. The reason why the stock price fluctuates so much is because when news comes in, they will change the prediction of what's going to happen in the future. So, for example, I think was it recently Alphabet, the Google started paying dividend, right? Like their very first dividend. So all these years they have never paid dividend. If you study basic finance, the way they value a company, the stock price is basically the future dividend discount back to the current price. So if they pay dividend, say 10 years in the future, then 10 years dividend they pay out, then you just discount it back at the market interest rate. And that will be the valuation of the shares. So you can think if the interest rate goes up, your denominator becomes bigger, right? That's why the share price will go down. If the interest rate goes down, then the share price will go up. That is just pure interest. But if the company, if for example Tesla, Model 3 or a new car, suddenly people expect the company to make more revenue in the future, then your stock price will go up because it shows that in the future the dividend will be higher. But of course, a lot of companies they don't pay dividends because they want to reinvest whatever revenues they have back into the business, right? Or another way they can do it is via stock buyback. So they'll buy back their own shares because that's to avoid tax. Because normally what happens is whatever revenue that the company makes, they have to pay tax, right? Corporation tax. And if they issue the dividend to you, then the shareholder has to pay another tax on the dividend, right? So it's a double taxation. So rather than passing the cash to you, right, to the shareholders, they just use the cash to buy back their shares. So the share price goes up, and then you also gain, but you will gain it after you sell the shares. So issuing as a dividend or a stock buyback is basically the same thing, and just that you avoid this double taxation. Yeah, Andre.
Let's say the business issue dividends. Would they issue dividends in the S&P 500 as well? Like
Yeah.
would the investor for S&P 500 get those dividends as well?
Yes, you will get the dividend as
Oh,
well.
okay.
Yeah, as far as I know, there's a withholding tax for dividend. So, for example, if you buy the SPY shares, right, you would have when they pay dividend, straight away the U.S. government will withhold. Last time was 18% tax. Straight away they will hold on to 18%. They will just pay you the remaining, right, 82%. I think now the withholding tax is like higher than that. But for SPY, for S&P, they don't actually pay a lot of dividend. So that's not really a very big issue. But for uh, 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 countries like Singapore companies, so all those blue chips companies, those banks, whatever, they pay a lot of dividend, right? So those are the dividend will be a lot more. Yeah, Kenneth, yeah.
Oh yes, we have around 15 minutes left.
Okay, so this is actually a very interesting thing I want to talk about. Is I used to have a friend when I was working in Shanghai. He told me he bought this ETF or something, and he said that from a year ago until now, so basically it went down, then it went back up, right? So from the year ago until now, the stock price basically didn't move, right? So basically, it means that you're not making any money, right? You're not making any profit. Or we talk about Nikkei 225, right, which is the Japan's Tokyo, Japan's stock exchange, the index equivalent of S&P 500. As you know, the Japan, they have this bubble when it bursts. If you see the Nikkei, it only recently went back to the high before the bubble burst in the 90s, early 90s or something. So basically, Nikkei index just go down and go up, go down and go up. Basically, it's like straight line, right? If you look at the Singapore stock index, is also the same thing. It's pretty much like, it doesn't actually like the S&P 500 that goes up. It's always like a straight line. Like pretty much, it seems like it's not making any money. So why would anybody want to invest in an index that doesn't move? Have you ever asked yourself why? Like, who would want to invest in Nikkei? And was my friend right that he actually didn't make any money if the stock price goes down and go up and back to the same level a year ago?
But
What do you guys think?
Does he get dividends?
Yes. The company probably pays dividend. So every time the company pays dividend, if it pays $1 dividend, the stock price would drop immediately $1.
Oh,
right?
okay.
Because it makes sense. If all else stays constant, I take out $100 from my company and pay it out. My stock price will just drop $1.
Yeah. Something else will be affected.
Yeah, but there will be other factors involved, but at least the dollar would drop just based on the dividend. So the reason why the stock price is there's nothing major going on, the price is about the same, is that they actually pay out the dividend. It would have gone lower, but it actually went up. And why it went up is because most of these stable companies, so for example, in Singapore, we have the DBS Bank. They have very predictable recurrent revenue, right? So every time they have the revenue, they make the money, then they will just pass it out as dividend. So the market, the price will drop, but then the revenue will come back up, it will go up again, drop. So basically, the valuation company is always like not really moving. But it's not like you're not making money, you're still making money, it just is paid out as dividend. And you can also reinvest the dividend, right? You can take the dividend and go and buy more shares. So you have more shares, you will get more dividends. So you still get the compounding interest. That's what we call the total return. And the reason why in the US you don't have this problem is because most companies in US is like a growth company. They want to be more innovative, right? They want to always have R&D and produce new goods and services. So they don't pass out the dividends because they don't really want to have recurring revenue. For most papa mama shop, those kind of normal corporation, their profit is always more from the normal predictable recurrent revenue, right? But for more like those that are always constantly innovating, what you want is they want to have, like Amazon, right? They want to have more future bigger revenue, right? So they don't want to have the same revenue. They want to always fight for a bigger, more revenue. That's why it's like it's a growth stock and not the other way around. Or actually, do you guys have any more? I think how much time do you have left?
We have around 5 minutes. I
We can
think
cover the rest in the next round.
Yeah, I think we will just wrap it up by you guys having any more questions. I'll try to keep my answers short.
yes, I have questions. It's about how the stock market work, right? Let's say a company, I wanted to go to public, right, and I issue shares, right? Does that mean the shares the company own is less? And if so, if I need more money, I issue more shares. Does that mean my ownership of the shares will further be diluted?
Yes, it will be further diluted. But it makes sense, right? The reason why you are issuing shares is because you want to get more capital to grow your company, right? Because without this capital, you cannot grow the company any further than what the bank is allowed to lend to you. So in order for you, and even though you're diluting the ownership of the company, but your company will be worth more in the future, right? So do you rather have 100% share of a company that's worth $100 versus a company that you only have 50% shares, but it's worth $1 million. You know, so yeah, there's a whole reason why people are able to willing to sacrifice their ownership is because that will grow the company.
Yes, I have a follow-up question on that. So sorry.
Okay.
So if Apple and Google are in the market for a long time, right, like over 10 years, does that mean they keep on giving out their ownership in exchange for more
Better
capital?
Uh, okay. Normally, they will issue more shares if they want to expand their business in certain arena, right? If they want to raise more money, they will issue shares. Most of the time, they don't issue more shares. What you always hear about is in the secondary market. Basically, it's already existing shares that are trading in the market.
Okay.
Yeah.
Yeah, but that would be a risk to the founder or the owner of the business, isn't it? If his own shares get diluted to a point that there's a possibility where his decision will not be the important decision anymore, and if various shareholders might just come together and combine their shares and
No, but
overthrow the founder.
it might be a good thing, right? Because what makes you think that the founder are good for the company? As long as once you go public, the company is no longer yours, right? It belongs to the shareholders. And if the shareholders feel that the founder is not contributing to the company, they can easily oust the company the founder, right? Like the founder is not their father or mother, right? To me, the founder is maybe if the founder is some idol kind of person, with like maybe Elon Musk. You're not like you have no special feelings for the founders, and a lot of founders they are good at finding the company, but they are not good at running the company. So
Okay.
yeah, it's not like in Asia, in Asian culture, right? Where it's like a family business, or you're afraid that somebody will take over your company. And then that is a different thing.
Oh,
Then that would
okay.
be like, but then again, there's a Chinese saying that, your family fortune will not go over 3 generations, right?
Okay.
And
Yeah.
the reason why is because if you
Mm,
keep, passing your business to your own children or
yeah.
descendants, one day the company will not survive, right? But if the company is supposedly public, it's already outside of the founder, so there is no really any
Oh, okay.
reason, yeah, that
Yeah.
because
Yeah.
all the shareholders they all want the company to do well, right? Which
Yeah.
is
Yeah.
why they,
So
yeah.
yeah. So unless the founder is able to buy more shares to gain back the majority,
But most of the time,
right? Yeah.
the founder also would not really care about wanting to have the majority, lah. Unless
All
the
right.
founder is a very weird, like some kind of control freak or something,
I see.
Like, yeah, it's not like in general, uh, by right you should feel detached to the fact that because the company is no longer yours as you go public, right? Because now you have shareholders and stuff like that. Yeah, but that is the sacrifice that you have to make if you want the company to be very successful. Do you think Apple will be able to achieve what it has attained now if it's just purely a private company? Probably that's not going to happen. But of course, there's a lot of those Rothschild or the Rockefeller families where everything is private within their own family, and yet they're also making a lot of money, right? And the money is not even public, as in these companies are not public, so we don't even know how much money they have. But they certainly do have a lot of money, right? Yeah, run for generations and stuff like that. But that will be an entirely different story. Anyway, any more question?
I think the time's up. Thanks so much, Jason and Andre, for coming into live stream this podcast. For everyone else who's been listening to this podcast and found it valuable, remember to follow our channel and also subscribe to JasonInvesting.com. And we'll see you next week. Bye bye.
Right. Thanks,
Thanks all.
everyone.
Thank you.
Bye.
Bye.
Okay, I've stopped the streaming. Wait, let me just